Amin Reina here from Sage Investors, here to do a quick evaluation of restaurant brands, ticker symbol QSR. Now, every time I am analyzing a company and ultimately analyzing a stock, I always ask myself the same set of questions to give me a good idea of what the company is about, what it does, how good it is from a financial perspective, what are the risks involved, and ultimately if the stock is cheap. So I'm going to do the same thing here, apply the same logic and framework to my evaluation of restaurant brands. So first question I always ask myself for every company I'm evaluating is, what do they do? What is their value proposition? What do they sell? So in the case of restaurant brands, they are essentially, in a way, kind of a holding company that consists of a whole bunch of different low-cost restaurants. Restaurants specialize in food, food and beverage, and their most prominent businesses that they have, or restaurants that they have, are Tim Hortons, which is the coffee and donut shop, very much an iconic brand here in Canada. They also own Burger King and Popeyes chicken, fried chicken. Those are kind of their main ones. And in terms of the competitors, for each of these companies, each of these restaurants, they have their own set of characters. So in the case of Tim Hortons, their main competitors are against similar coffee kind of style shops, and that would be your Second Cup, your McDonald's, Panera Bread, maybe it's a similar kind of company, and Starbucks would be in that sense. Burger King, it's basically your other fast food hamburger joints, your McDonald's, your Wendy's, Subway, and now you can throw in Chipotle, and even Panera Bread in that sense. And even in a sense, and then Popeyes would probably be, their similar brand would be like the KFC chain in terms of the chicken side, maybe Swiss Chalet. So as we can see, these companies within restaurant brands are very unique in the sense that they also operate in spaces that are very, very competitive and very hyper competitive in that sense. So who goes to these types of restaurants? Well, basically, you can say anybody goes to that restaurants, but especially when you look at a company like Tim Hortons, it's very much the iconic brand, the iconic Canadian company, and people go for their double for coffee. So they have a very loyal following, more so probably the most loyal following, I would say, compared to their other two in terms of Burger King and Popeyes. Maybe so more so in the US, but in Canada not so much. But it's really Tim Hortons that kind of gains a lot of the oxygen when you take a look at restaurant brands. The types of customers, they're very loyal. Will they come back? In the case of Tim Hortons, yes, they will come back. They come back over and over and over again for their coffee, for donuts, and now for a wider variety of food options too. So loyal customers, they definitely have loyal customers. Next question I always ask myself then is, does the company make money? Is this a company that's profitable? Ultimately, we want to invest in companies and businesses that can show that they can create excess profit, can throw out extra cash, create tangible wealth. When I took a look at restaurant brands on their whole, one of the common metrics that I look at are return on invested capital, the ability to generate profits in relation to the amount of capital that's invested in the business. When you looked at Tim restaurant brands, their return on capital comes in, last year came in around 8%. The year before it came in around 8%, and last year it went up to 8.7%. Cost of capital, and I'll get into this a little bit when we talk about the balance sheet, on a rough basis, comes in between 8 to 10%. So when you look at it from this perspective, the company is not really generating any extra returns on capital compared to the amount of cost of capital. So in a sense, their ability to create tangible wealth, or as I like to call it, economic profit, it's very muted. And you could almost say it's negative in the sense that they're actually destroying shareholder capital. And that's not a thing we want to see when the types of companies we want to invest. We want to see companies that have pretty high returns on capital compared to their cost of capital. So this is not a good sign right off the bat. When we started looking at the when I started looking at a little bit more in the financials, specifically in the balance sheet, I noticed that the company at one point last year had almost $11.2 billion in debt, which is pretty crazy. It had almost 3 times debt versus equity, which is very high, and something that we really don't want to look at. If you dig down deeper in terms of looking at the company's assets, almost 65% of the company's assets are intangible. This is a company that's been growing essentially by buying other companies and that's really what they've done. You know, they've bought Tim Hortons, they bought Burger King, they bought Popeyes. They didn't organically create the companies and the restaurants that are in their portfolio. They basically went out and bought for them, and they've essentially paid, to a certain extent, a higher price, and that higher price is reflected in their intangible assets. So when I look at the company from 2 perspectives, the company's got a lot of debt, quite a lot of debt, and quite a lot of high intangible assets. So it tells me the quality of the company's capital, the quality of the company's assets is not great. And when you layer on top of that, the company's generating somewhat mediocre returns, these 2 factors together start to make things not too compelling to want to go buy this stock. But let's go further, just for argument's sake. When I looked at some of the risks, there's certain risks that are, you know, that most restaurants and food-oriented chains face, and one of the natures is this: it's the cyclical nature of the economy. It's very sensitive to the whims of the economy. If people don't have money to spend, they're not going to. The first thing they're going to cut are spending and eating out. So companies like restaurant brands, companies like Tim Hortons, Burger King may suffer from that. Could potentially suffer from that. The nature of the business, restaurant brands, their philosophy is they really are all about cost control, and they're pretty hyper in terms of cost control, and it's kind of had some ramifications in terms of how the businesses have been operating, more so especially with the Tim Hortons side of it. There's been a very public battle going on between HQ and the franchisees in terms of how the HQ wants these restaurants to be run, and they're really, it's been very public, and it's been very negative in the sense in terms of the public relations side of it. Then also there was the issue of in Ontario where the Tim Hortons franchises started dropping benefits to their employees because of the increase in the minimum wage. And that got a lot of negative publicity. The end of it, right now, there's a certain perception out there that management right now is kind of pretty tone deaf right now, and tone deaf to what their franchisees, the people who are like the boots on the ground, what they're seeing, what they're experiencing. They don't seem to be taking what they're putting out there seriously. They're not listening to them very much, and there's a lot of tension going on. And the second side of it also is they're not really creating a lot of PR issues with their customers. And, you know, one of the things we talked about, especially with the Tim Hortons side of it, is there's sort of a loyalty. They've built up such an element of trust and loyalty to the Tim Hortons brand. But if these type of visible public relations kind of things, negative things, vibes kind of gets out there, it's going to impact the loyalty on it. So that's something, these are risks that the company, you know, should be able to manage through, but right now it continues to seem to be having a bit of a hard time doing that. So that's the risk side of it. So at the end of the day also, is the stock cheap? What's the stock, if we're trying to look at valuation right now, is the stock cheap? Right now, the company is trading at about 22 times forward earnings, which is pretty pricey from that sense. If you look at the PEG ratio, though, it's trading at 1.5 times, which is okay, and has a free cash flow yield of about 5.5%, which is, again, it's okay, it's great. If you're looking at an intrinsic value for restaurant brands right now, a lot of the valuations that I've seen of it, see the target coming in around the low 90s, and right now it's currently trading at around 75. So from this perspective, it's cheap, but from a relative basis, when we're looking at a relative basis, it looks pretty pricey. I guess the wild card in all this is, despite what right now looks like a very kind of, not really a very exciting kind of proposition in terms of the stock, the wild card in all of this right now is Buffett is an investor. He owns some preferred shares. He was one of the primary, he provided a bit of financing that allowed restaurant brands to go buy Tim Hortons. He seems to be a fan of the company's management, despite the certain governance issues that we're seeing here. Buffett seems to be, he's still on board with the company. So when we look at when we take everything into account, we seem to be a company that has quite a bit of brand loyalty, especially the Tim Hortons side of it. Operating, it's more than holding its own against a variety of extremely tight competition, aggressive competition, has a loyal customer following. So it seems like it's got all the good stuff here. But then when we start looking at the financials, we see the company's financial position is very heavily in terms of intangible assets. It's got a lot of debt, even though the debt level, the company is saying is going to aggressively trying to reduce it. Even if they were to reduce it, that's probably going to increase the cost of capital for the company. And if the company continues to generate, single-digit returns on invested capital, it's not really going to be generating any significant or meaningful economic profit. And in fact, it might be actually destroying capital. So when you factor kind of the weak financial performance of the company, highlight that with sort of the weak governance that's behind that company in terms of management's sort of lack of sensitivity in terms of what's going on with their customers, what's going on with their employees and franchisees. Potentially, you could see a lot of that goodwill that the company's developed over the years, or specifically Tim Hortons, the Tim Hortons brand is level over the years, could really start impacting the stock price. And so right now, even though the stock price looks cheap on a valuation perspective, but relatively pricey on a relative valuation, it's just really hard to get excited. I find it really hard to get excited about this stock. So if I were to make a decision right now, my decision would be I would not buy it. So there you go. That's my analysis, quick and dirty analysis of restaurant brands, ticker symbol QSR. You can find more similar types of analysis and information about my podcasts and my coaching services and my online courses through my website, sageinvestors.ca. Thanks again. We'll see you later.